cash return yield company shareholders have. Let me give you the historical pattern for S&P 500 itself. If you go to Mult PL, it's like multiple, but there's no I or an E. Most of this data in this website is maintained by Bob Shiller, who's a Nobel Prize winning economist. I mean, it's in his website, but these guys kind of made it into charts and stuff. So I don't think Bob Shiller is complaining too much. His name goes out there. More dividend yield. Let's just look at the last 20 years, okay? I mean, dividend yields were very high, but after 2008 crash, partly because companies did not change their dividends, but the prices went down, so the yields went up. Currently, it's $1.14. This is for the entire economy, okay? Which is a pretty low number. And if you look at only the last 10 years, 10 years ago, it was about double. So there is a historical kind of trend. The companies are willing to pay less in dividends. It does not necessarily mean that they're returning less cash to their shareholders. They kind of prefer stock repurchase. One of the reasons for that is a lot of times firms believe, rightly or wrongly, that their stock is undervalued. But, you know, maybe the people know a lot more about the company's prospects than we do. They know what sort of future projects they're planning. They've already done their, NPV type analysis on those. But we don't necessarily know those. Some of the equity analysts may know, but the information is not perfect. Even in the market right now, let me see where NVIDIA is trading. 188, okay? Money, but the expiration date is January 2028, so I'm not worried about that. If you look at Robinhood, the so-called fair market value, using some sort of model, is $225. Even the equity analysts believe maybe it's undervalued. Whether or not that's true is besides the point. I personally believe NVIDIA should be at least $300. In fact, one of my options is that it's going to go above $420 by January 2028. Whether or not it does, it's besides the point. As the stock prices go up, full option values goes. I don't have to wait until then to make my money. So when companies believe that their stock is undervalued in the market, it's better for them to buy it back from the market cheap. Later on, they can sell it back to the market. Given that dividend yield is not necessarily using dividend yield plus the growth rate is not necessarily a good idea. Use what we call earnings yield instead. Let me show you what the earnings yield for S&P 500 is. Let's look at the last 10 years. It is somewhat stable. Obviously, earnings took a dive around the COVID area. It's normal. But the historical trend is somewhat of a constant. I mean, there is some variation around some sort of mean, but there's no upward slope or downward slope. Currently, it's 323. It's close to 3 times what dividend yield is. So using dividend yield underestimates the cost of capital. And that's important because if you use a cost of capital that is much below what it should be, you're accepting projects that are risky. Using the proper rate, they would not have been profitable. You end up accepting those. Think about the earnings yield. It's expected earnings next year divided by price now. This looks awfully like 1 over forward price earnings. Remember, forward price earnings is price divided by expected earnings next year. So for NVIDIA, for example, current FPE is, let's go to statistics. 2933. And assuming a constant growth rate of earnings for NVIDIA is probably not appropriate, but let's say it is, okay? If G is, let's say, 8%, then RE would be, let's see, 1 over 2933 plus 8%. Got to type the plus. So 1141, or earnings yield for NVIDIA. Actually, the earnings yield itself is pretty much close to the overall market. But what would make the difference is what you want to call the growth rate. For a company like NVIDIA, assuming a constant growth rate starting next year is probably not a good idea. We can use implied growth rate for implied discount rate for a two-stage growth model. But use earnings instead of dividends. So let me go back to our stock price template or dividend growth model template. Okay. Let's see. I'm going to add Oops, not that one. Basically 5 years of dividends, which I'm going to use as earnings. For example, if I go to analysis page, let me see, for the current year, 2026, which is going to end January 2026 actually, 454. So let's do that as first year. It's more than that, but I'm kind of trying to make it simple. After that, I'm going to use about 30% growth rate for all of the 4 years. Okay. Then after that, I'm going to assume a constant growth rate. I usually use growth rate of the economy, 5%. Okay. Now, right now it's calculating market value, but I want the required rate, and current market price is 188. Gives me a required rate. It's kind of an underestimate because this company probably